You are on a deck in the middle of the ocean, convinced you got a deal on a vacation. But you are inside a closed-loop system built to extract profit long after you board. The ticket is just the baseline. The real product is the monetization of captive transit time. Look at the numbers. For Royal Caribbean in 2023, passenger ticket revenues were 68.8% of total revenue. The remaining 31.2% came from onboard spending. You think you bought transport and lodging. You actually bought entry into a floating captive retail mall. If the ticket price is not the main event, what does that fare actually cover? That ticket price pays for the fuel, the crew, and the basic maintenance required to keep the ship afloat. It is the cost of entry, not the profit on the product. If a cruise line were forced to survive on these fares alone, the company would fold within a single fiscal quarter. The ticket is merely the logistical tether that keeps you confined to the vessel. Once you pass through the scanner, you are no longer a guest. You are a participant in a closed-loop consumer ecosystem. The ship is a floating, high-density retail mall where every square foot is calibrated for extraction. This is the business model. You think you are paying for a vacation, but you are actually paying to be sequestered in an environment where your every waking hour is monetized. If the ticket is just the bait, how do they ensure the ship remains a profitable engine even when a cabin is sold at a deep discount? And how do they manage to consistently push occupancy rates beyond the standard 2-guest cabin baseline? The answer starts with a quirk in how the industry counts. Every ship benchmarks capacity at 2 guests per cabin. That baseline means a sold-out vessel fills extra berths, 3rd and 4th beds tucked into rooms. Load factors above 100% aren't anomalies. They are the target. Once every berth is occupied, the real extraction begins. The ticket serves only as the invitation to a secondary business that activates the moment the gangway closes behind you. And the moment it activates, the ship splits into 2 businesses sharing the same hull. Business 1 is pure utility, transport from port to port, a cabin to sleep in, a buffet to eat at, a moving hotel. The marginal cost of adding 1 more passenger to a ship that is already sailing is nearly zero. The crew is under contract for the voyage, and the cabin exists whether you occupy it or not. So the ticket price is set to cover the operational baseline and to guarantee every berth is full. A passenger who pays just enough to break even is not a loss. That passenger is raw inventory for the second business, the one that actually generates profit. Business 2 activates the instant you tap your cruise card at a bar. The entire onboard environment runs on an integrated, frictionless loop where your room key becomes your wallet. There is no moment where you reach into your pocket, count bills, and decide whether the cocktail is worth it. Every charge goes straight to your account with a single tap. The specialty restaurants, the spa upgrades, the beverage packages, and the shore excursions do not exist to improve your vacation. They exist to maximize per-passenger yield inside a closed environment where you have no alternative options. Cruise lines manage this split with precision. The highest margin categories, casinos, beverage programs, and excursion bookings, stay under direct company control. The lower margin but still profitable retail shops and spa services are handed off to third-party concessionaires who pay the cruise line for access to thousands of captive guests. That division between owned and outsourced revenue streams is where the entire margin architecture of the business begins. The question is how the ship actually gets you to spend far more than you ever planned. The answer is in the architecture of the transaction itself. The cruise line keeps direct control over the most profitable streams. The casino is always an in-house operation, the house edge funding the profit. The beverage package is a prepaid subscription that changes consumption habits before you board, locking in high-margin sales. These are the primary profit engines, held under tight operational control. For the lower margin, higher overhead services, the spa, the retail shops, the art auctions, they outsource to third-party concessionaires. These partners pay the cruise line a fee or a revenue share. The line gets steady income without the staffing complexity. The strategy is simple. Own the highest yield assets, lease the rest. Every design choice funnels you to these transactions. The entire ship layout acts as a retail corridor. The cashless card system removes the friction of payment. You swipe for a drink, a tour, a massage, and the cost becomes an abstract number on your final bill. This system feeds data for real-time cross-promotion. You play slots, and the bar screen offers you a discount on premium liquor. It is a closed-loop ecosystem engineered for continuous spending. In 2023, passenger ticket revenues were 68.8% of Royal Caribbean's total. reaching $9.6 billion. But the onboard and other revenue segment contributed a significant portion, a 31.2% share that represents the true profit layer. For Carnival, the pattern is identical. Ticket sales made up 66% of total revenue in 2024, hitting $16.5 billion. Compare that to the $7.5 billion in onboard revenue generated the prior year. The onboard dollar carries a dramatically higher net margin. Norwegian's onboard segment alone brought in $2.9 billion out of $8.5 billion total in 2023. You purchased access to a calibrated liquidity trap. The financial model depends entirely on what happens after boarding. But if onboard spending is so profitable, why not eliminate the ticket price altogether and fill the ship with pure spending targets? The answer lies in a completely different layer of the math, a cost structure that turns the ship itself into a peculiar financial instrument. The ship is a massive fixed asset, a floating infrastructure that demands constant revenue to justify its existence. Fuel costs consistently hover between 2 and 4% of total company revenues, making energy expenses a manageable variable compared to the crushing weight of the vessel itself. Once the ship leaves the dock, the marginal cost of hosting one additional passenger is remarkably low, driving the obsession with volume. Every extra person booked creates this immediate contribution margin for the internal ecosystem, because the crew, the lighting, and the ship's course are already fully paid for by the baseline ticket revenue. This is a probability game. This creates a paradox where operators prioritize occupancy over ticket yield. They would rather fill a cabin at a discount than leave it empty, because an empty bed represents a total loss of potential extraction. The real money is in the capture. If a company operated with such heavy capital deployment while being fully tethered to the domestic tax laws of a major nation, the overhead would collapse the margins. Yet these lines retain the resources to reinvest into the next generation of larger, more complex machines. They achieve this through a specific legal structure that bypasses federal corporate income taxes under Section 883 of the Internal Revenue Code. While you are browsing the drink menu, the company operates in a tax-advantaged vacuum that alters the entire math of their growth. This structural advantage explains why they can afford to keep ticket prices low to drive high-density volume. The next piece of the puzzle is how they turn that volume into over 100% occupancy, and which hidden levers they pull to ensure your spending exceeds the initial cost of your room. This volume strategy relies on a structural advantage that defies standard corporate logic. You would expect a massive global enterprise to pay the same federal tax as a land-based corporation, yet it does not. Foreign cruise ship operators conducting trade in the United States are granted corporate federal tax exemptions under Section 883 of the Internal Revenue Code. This legislative architecture is what allows the machine to function. While domestic firms pay standard income tax on global earnings, these lines utilize an exemption for income derived from the international operation of ships. By registering fleets in foreign jurisdictions, they treat their corporate tax liability as effectively zero. That missing tax line is not just money saved. It provides the margin necessary to keep ticket pricing artificially low. This low-price strategy ensures the vessel remains at maximum capacity, keeping the ships filled with passengers who become part of the captive ecosystem the moment they board. You see a boat sailing and assume it is a transportation firm. It is a tax-exempt entity maximizing volume to saturate a captive market. Because the cost of entry is minimized to drive that volume, the lines subsidize the ticket price, knowing the revenue is realized through your onboard behavior. This is the logic of the loss leader scaled to the size of a floating city. The strategy requires a total commitment to scale. Because the primary benefit is tied to the international nature of the trade, ships must maintain precise itineraries that keep them in transit. This operational requirement dovetails with the need for high passenger turnover. Ships are high-velocity machines that must reach maximum efficiency in every category of spend. Every square foot of deck space is a billboard or a point of sale. If a venue does not contribute to the ancillary revenue stream, it is structurally replaced by one that does. If the tax exemption handles the overhead, the internal mathematics of the cabin must be ruthlessly precise to ensure every guest generates a net yield. That brings us to the unit economics. We calculate how they drive profit by balancing direct management of high-margin items like casinos and beverage packages against the concessionaire model used for retail and spas. Now that you understand the mechanics of the tax-advantaged hull, the unit economics we look at next reveal the hidden price of your presence in that cabin, and why the industry is desperate to get you into a fourth berth. The tax-advantaged hull sets the stage, but the unit economics reveal why they will never stop selling you a fourth bunk. Here is how they model profitability. The company directly manages the highest margin activities on board: casinos and beverage packages. This is about capturing the total yield from every drink and every spin, keeping this revenue stream entirely in-house. For other offerings, like retail shops and spas, they outsource to concessionaires. This hands off the inventory risk and staffing overhead to a third party, while locking in steady contract fees for the cruise line. This creates a layered profit machine. An integrated cashless point-of-sale system eliminates the friction of physical currency. Every purchase becomes a silent, continuous microtransaction. Constant cross-promotions steer passenger spending toward these managed, high-margin products. The fixed costs of the ship, the asset that sits still while the money moves, get diluted across the maximum possible volume of onboard spend. Look at the numbers from Royal Caribbean Group in 2023. Passenger ticket revenue was $9.6 billion. That is 68.8% of their total revenue. That portion covers the baseline. The other 31.2% came purely from onboard and other ancillary sources. Carnival Corporation shows the same model. $16.5 billion in ticket revenue for 2024 made up 66% of their total intake. The remainder is the extracted value from the captive ecosystem. Consider the single biggest cost after the ship itself: fuel. For these giants, fuel expenses represent only 2 to 4% of total company revenues. This is the critical economic insight, because the marginal cost of adding one more passenger to a sailing ship is almost zero. The fuel burn does not change. The business is built to maximize the number of human beings inside the hull. Every additional passenger is pure incremental revenue against a near-stationary cost base. This is why the industry's performance metrics do not stop at a full ship. The financial model relies on a specific trick of accounting that lets them report occupancy rates well above 100%. This confirms what that structure means for a cabin built for two. And if the marginal cost is near zero, those razor-thin margins vanish if the engines stop and the cabin's empty. That is where the model's hidden vulnerability appears. The machine is designed to bypass the physics of capacity. When an analyst looks at a ship's capacity, the math starts at the cabin count, assuming exactly 2 guests per room. That is the baseline, but the business does not stop there. It optimizes for the family room, the pull-out couch, and the upper berth. By marketing to groups who fill these third and fourth slots, the ship pushes occupancy numbers beyond the hull's theoretical limit. Royal Caribbean proved exactly how aggressive this can get, hitting an overall passenger load factor of 107% in the first quarter of 2024. That is not a rounded figure. It is the result of squeezing more guests into the existing inventory than the original architectural blueprint ever intended. This is a deliberate strategy to dilute the fixed costs of the vessel across the largest possible volume of bodies. Each additional passenger consumes minimal extra fuel. The marginal cost of serving that third guest in a cabin is near zero, yet they are now trapped in the same high-density consumer extraction engine as everyone else. They buy the drinks, they lose money in the casino, and they pay the daily gratuities. When the ship hits 100% occupancy, it has reached its base efficiency. When it hits 107%, the profit margin on every one of those extra passengers is pure cream. Think of it as a real estate developer who found a way to add an extra room to a house that was already full. Every berth added is a new entry point for the cashless system. Every head in a bed is a new source of captive revenue. And this is where the industry's reliance on volume starts to expose its own structural fragility. You might assume the ship makes money when it sails at full capacity, but you have to wonder what happens to these margins when the engine room stays silent and the guest list hits zero. That leads to a much darker reality regarding how these behemoths sustain their operations when the world stops moving. That is not a small difference. It is a different business entirely. Now that you understand the mechanics of the floating casino, have you considered how these giants survive when the revenue spigot is forced shut? And it almost breaks them. When the sales stop, the machine doesn't just pause. It bleeds from 2 directions at once. First, the fixed costs. Crew salaries, maintenance, and massive debt payments for those billion-dollar ships don't go on holiday. They accrue daily, whether the ship is sailing with many guests or tied to a dock with zero. This creates a terrifyingly high floor for survival. The real damage is to the profit engine. Remember, the ticket price is just the entry fee. The actual margin lives in the billions of dollars of onboard and other revenue Royal Caribbean booked in 2023. That entire stream, casino chips, cocktail packages, spa bookings, vanishes instantly if the ship isn't moving. The integrated cashless system has no one to charge. The bars are dark. The high-margin microtransactions stop dead, leaving only the shell of massive fixed costs. Fleet deployment is an existential metric, not just an operational one. The financial model doesn't just prefer full ships, it demands them. Look at the proof. Carnival's total revenue crashed during downturns, then surged back to $21.6 billion in fiscal year 2023. That recovery wasn't about selling more tickets. It was about getting the fleet fully deployed and occupied again, because only then does the secondary revenue engine, now representing over 30% of the business, turn back on. Every empty cabin is a double loss. The baseline fare is gone, and the chance to trigger a cascade of high-margin spending disappears with it. The system requires constant, full-volume circulation to service its own weight. When that circulation stops, the entire valuation model, built on perpetual motion, begins to fracture. The industry isn't just selling a vacation, it's selling time on a capital-intensive treadmill that must keep running to justify its own cost. The cruise industry is a lesson in captured economies, where the cost of entry is kept artificially low to maximize the volume of the captive audience. A cruise line does not sail ships, it sails wallets. Now that you see the engine, consider what happens when the entire global economy is the ship and there's no dock to return to. The cruise industry is ultimately a lesson in captured economies where the ticket price is kept artificially low to maximize the volume of a captive audience. The vessel itself is merely the delivery mechanism for a high-density, closed-loop extraction system designed to bypass standard retail friction. When you realize the vacation is the loss leader, you stop seeing a boat and start seeing a platform built for continuous microtransactions. This is the fundamental engine of the business. Once the ship leaves the dock, every beverage, every hand at the poker table, and every premium experience is optimized to strip the variable cost per guest to near zero while maximizing net yield per cabin. You are not booking a vacation. You are entering a controlled environment where the ship, the service, and the sea itself are secondary to the throughput of your own capital.